Hello again, everyone. I'm Chris Safadi. Once the holiday season is over, hate to say it, it'll be tax season. And this year, between the two hurricanes and then Ian, there are some things you'll want to do that could get you back thousands of dollars. Here's the checklist to get it done.
If only tax preparation was as simple as making a list and checking it twice. But here's the gist. First, collect your documents.
So thinking in terms of process, the very first step is simply going to be gathering all of the documentation, whether that's information submitted to insurers, quotes from general contractors, anything to attempt to quantify the damage.
Next, your out-of-pocket expenses. Identify things FEMA or your insurance company didn't cover.
Anything that's excluded from the policy, obviously you're not worried about double dipping, right? That's not a reimbursement that you're expecting to receive.
That might be damage to your pool or patio, or the difference between what you spent on repairs and what your insurance company paid you back for.
That's what the IRS terms a casualty loss. So if you're not being reimbursed on that and you're above that itemization threshold, absolutely that would be deductible.
That itemized threshold means make sure you have enough to deduct above the standard deduction. Otherwise, all this work won't get you anything. And then this is where it gets tricky.
I will say the IRS will push back very hard on that if you're going to go that route.
So the next thing on the checklist,
speak with an advisor. CPAs are qualified to handle this stuff.
Stuff includes things like paying for another place to live if your insurance didn't help, which flood policies don't.
You had better have ironclad documentation.
Another thing you'll want to be careful on and talk to an expert, taking a deduction for the decreased value of your property after a storm. And make sure you hold tax documents for at least 7 years in case the IRS asks any questions. Back to you.